I don't know how many people are familiar with the grappling sport of Jiu Jitsu, but I am absolutely addicted to it and I love it to death. And I've learned on the mats in Brazilian Jiu Jitsu and in the markets that success comes from the same three things: discipline, consistency, and planning ahead. Now, while those lessons have shaped me as a martial artist, they've also shaped me as a financial planner because the truth is your health and your wealth follow the same rules. All right. The small, steady actions you take today can create huge rewards for you in the future. Now, for those who don't know me, my name is Guy Woodard. I am an international financial planner here at Holborn Assets. I've been in the business for over 25 years in terms of financial services. I got my start in a small town called New York City. Perhaps some of you have heard of it before, where I started on work my way through Wall Street up to head of compliance before I took on a client-facing role after relocating to here to Thailand a little over 10 years ago. Now, my passion and really my mission is to bridge the two worlds that I believe are inseparable, which is building wealth and maintaining wellness. Now, I know not everyone here lives in the gym or meal preps every Sunday, but because I do understand that life gets busy. But I think we can all agree that we want the energy, the freedom, and confidence to come that comes with having the best feeling from taking those proactive actions. Just like we want the security and choices that come from sound financial planning. Now, for me, my number one passion, as I mentioned to you before, is Brazilian Jiu Jitsu, besides being a husband and a father to a very active 3-year-old. But alongside with my Brazilian Jiu Jitsu, I'm also into healthy eating, strength training, meditation, and time in nature. But the real takeaway isn't about doing exactly what I do. It's about having the financial and personal freedom to live the life on your own terms, however that looks to you. Now, that's why I'm such a strong advocate for tools like universal life insurance. And that's the reason why we're all here today. It's not just a safety net. It's a way to grow wealth tax efficiently, protect your family, and give flexibility in the future, not only to yourself, but also to the ones who you care about the most. Now, when you integrate something like universal life insurance into your plan, you're not just making a financial decision, you're building a foundation for resilience in every area of life. So as we dive into today's topic, I invite you to think of universal life insurance as a bigger picture, a truly holistic plan that supports the life that you're living and the one you want to create in the future. So with that said, I'm going to allow Richard to give a presentation on universal life insurance and how it could potentially benefit you, not only you, but the ones who you care about the most. All right, go ahead, Richard.
Thank you very much indeed. And let me just put my screen on there. Hopefully you can see my screen, everyone. Is that coming through nicely there?
And sorry, let me just interrupt you, Richard, before you get started. If anyone has any questions, feel free to drop it. You can send us a message over, and we will be answering questions at the end of Richard's presentation. My apologies, Richard.
No, not at all. And I think your introduction is very relevant. Like you, I'm a married man. My kids are a little bit older than you, but still pretty active. And I think ultimately what I want is to have that financial security for them in the event that I'm not here or my wife Claire is not here. And at the same time, I want to sleep well at night. So insurance is when you think about it, it's a very boring subject. So what I'm going to do in the next 25 or 30 minutes is lighten things up a bit. And hopefully, if you can see something that you can identify with, then you are in very safe hands with Guy, helping to support and nurture any aspirations that you've got. And I think if it just gets your gray matter working in that direction to create that bespoke succession planning solution, to create a legacy, to maintain life as it is if you're not here, with a few add-ons, then I think that's going to be some time very, very well spent. So again, I thank Guy for inviting me to today. And that you can see on the screen a little bit about myself. I won't read it word for word, but suffice to say, I travel a lot, seeing our global partners around the world. I literally got back yesterday from South Africa. I've already been over to Thailand and spent time with Guy. This is our second meeting together today. So I love what I do. I've been doing it since 1987. I've won numerous awards for what I do, and I love it. I really do. Churchill once said, when you find a job that you love, you'll never work again. And I feel I'm kind of there. So a little bit about Continental before I go on there. I mean, Continental is a key partner to Holborn. We're almost like a plug-in, as in when they find that the suitable client for this type of solution I'm going to show you comes along, and then we get talking. So today I'm going to talk to you about universal life, as you've already heard, but I just want to whet your appetite first and just show you this. This is the death receipt. These are things that have to be paid whether you're living or whether you're not living. You can't suddenly take your kids out of school or stop paying your mortgage. And so what we're doing overall is to create some financial breathing space in the event that someone passes away. But at the same time, you're going to be seeing some very nice growth as well. But we just want to check at some stage to make sure that these things can all be paid off with a big payout from an insurance company with deeper pockets than all of us in this virtual room today. Because ultimately, no one gets out of this world alive. We're all going to die. We just don't know when. My boss, Ashok, said to me, he said, Rich, if you could know when you were going to die, would you want to know? And I thought about it for a little bit, and ultimately I said, no, I wouldn't. So why would you buy an insurance policy that potentially passes away before you do, when you kind of need it the most? And that's why a whole of life policy undoubtedly is the best. Term insurance is great if you've got a mortgage or something like that. In fact, I've got a term insurance policy for my mortgage, which thankfully will finish in 9 years, and then it will finish. But I've also got a whole of life policy. And, you know, we can all remember our wedding days, or those special days when we got together as if it was yesterday. I can remember exactly where I sat at the table, and exactly where we walked. I can remember everything. And we want to make sure here that we look after the person we love or the business we love as much as possible in the event that we're not here. So to have and to hold, till death do us part. So I want to show you 3 case studies, and I don't expect you to read these as such. I want to show you 3 case studies and just talk to you about what happened with 3 people, 3 real life cases. And I'll just talk you through those very, very quickly and just give you the sort of idea of what we were able to do. The first one was for a chap who was 33 and resident in the Middle East. And this guy, that's not actually him, but this guy was amazing. He had created an IT company from scratch, built it up. And as such, we were able to help and support him. And he wanted a $10 million policy. In other words, what he wanted to do was create a pot of money along the way, but also if he was to die along the way, he would get $10 million. And the beauty of working with Holborn and Continental is that we can choose from a number of different solution providers, because one came back and said, well, no, we'll give him 5 million because he's only 33. And we said, we want 10 million. And then because he was so young and healthy and didn't smoke, for the same price, we got him $10.6 million, which was fantastic. And then we had this chap who was a major entrepreneur, along with his cousin, who couldn't get insurance from other people. But he came to us and it was declined, and we worked well with his health and we postponed it. And then 6 months later, we were able to get him covered for $3 million. And for me, this was the best ever case for 2 reasons. Well, 3 reasons, really, because he's still alive. Number 1. Number 2, he couldn't at that stage have children. A couple of years later, I get the call, we've just had a baby girl. Again, that's not him. And the third reason for me is his wife is doing a policy as well. So they identified this is what we need to create that financial breathing space. And then lastly, it doesn't have to just be young people. This gentleman was in East Africa, loved his family, wanted to create a legacy for his grandchildren, but at the same time, see some growth over time. So we got talking with his business partner, with his advisor, and two things happened that day when the doctor called me. Number one, we received a call that said he turned up on time. Number two, he's been admitted to a cardiac unit with a suspected heart attack. And thankfully, most insurance companies would have declined there and then. Thankfully, we didn't, and we were able to realize that it was treatable with drugs, and he is still alive, I'm pleased to say, and we got him covered. So let's talk about three things. What is universal life? Who is it for? And how does it work? So start at the beginning. What is it? Let's have a little look under the bonnet. Is it an investment? Is it a protection plan? Because it sounds like it's both. Well, it is. It's a multifunctional solution providing, as I've talked about, whole of life protection. On one hand, it's providing protection the moment the first premium or the payment comes in, but at the other side is it's growing. And it's that growth that's quite important because it provides long-term growth opportunities. But get this, it manages negative volatility. So when markets go up, you make money. And when markets go down, you're not exposed to them. And that's another reason I sleep well. I'm sure there are many of you, and there are many advisors out there in the world that panic the moment the markets go down with everything that's going on in that space, whether it's Trump tariffs or the Middle East or Ukraine, or dare I say, coronavirus. All these things have an impact on the market. But for the sake of this, that doesn't matter. And you don't see, as you would see with a share portfolio, the value of policy going down. So in terms of the sort of people that might participate or take out a policy with an insurance company, who would that be? First of all, it's your high net worth individuals, people that have made money and are looking to secure that and preserve that wealth. So this is for high net worth individuals. It's not a retail product. You wouldn't see this advertised on X or Twitter or LinkedIn or anything like that. And similarly, you may have a business. So you want to make sure that in the event of a director or the main man or woman passing away, that first of all, the business can continue. The staff keep their jobs. The clients stay with the company. The banks keep out of the way, and the competition doesn't get a look in. Then we have people with global property portfolios. Why should you have to sell that house in Phuket or Franschhoek or London just because someone has died? Creating that financial breathing space with a payout from an insurance policy means that is possible. And on a similar theme, why should someone have to sell their property because their husband or their wife has passed away? They probably will, but let that choice be theirs. So in a way, what we're doing here is creating risk management. If I have 100 people in this virtual room and I die, the insurance company thinks, okay, so 100% of my life is over. But from a business perspective, 99% of their clients are still paying their premiums. But for me, it's transferring the risk to my pockets to someone else with very, very deep pockets. So look at it as a utility. It's like turning on the lights. It's like flushing the toilet. It's like turning on the water. It's something that just happens in the background. There's nothing worse than having problems with water, or as Guy has seen problems with power. We pay the money to get it fixed, and we kind of don't feel we've moved any further forward. But nevertheless, we need it in the same way as we need life insurance. We love our children, we love our wives and husbands, and it's a moral obligation that when we do get married, or we do have children, or we create that business, that we go out and we buy some insurance like this. This isn't something that's sold to you. If someone here goes ahead with it, great. If they don't, my life will be unaffected. You buy it in the same way you put tiles on your roof. You hold it, you don't rip the tiles off your roof, and it's there for that rainy day when the inevitable will happen. So in other words, they're touched on. We are creating financial breathing space. We're just allowing that pause so that in the event of someone passing, it happens. And we don't know when we're going to die. I lost a family member only 3 weeks ago. He was 80, 89. But I also lost my sister when she was 30. So these things happen. And I'm sure plenty of people in this room have had similar events for people that left this world far, far too early. And if, my father died at 79, which was a decent age since he smoked from the age of 15. So we will talk about the solution providers. I'm not going to name them by names, but I'll just give you a theme of who they are and the gravitas that they bring to the table. But before I click on the next slide, why would you ever put money with someone no one's ever heard of, or someone that's just started out, or someone that might work, or someone that let's hope for the best and it should be okay? Why would people do that? You wouldn't buy a car from a company that just started 6 months ago. You would buy the Mercedes or the BMW or whatever it may be. And you want to make sure with life assurance that you buy it with a company who ideally are going to outlive you or your children. And you can get more details from Guy by following up this meeting today. This is really giving you that sizzle so you can actually go and talk about the sausage. It's whetting your appetite in the time that we've got today. But the key companies that we use, all of which are established for around 100 years or more, and some are even 150 years. And that's longer than my grandparents. They all hold the medals. So they've got independent, well-respected ratings. And as such, you are dealing with the biggest and the best solution providers on this planet. So in short, before we go on to see how it works, why would I use it? Because I want to protect the people I love. I want to protect my business. I want to create a legacy. I want to create a bespoke succession planning solution and create intergenerational wealth for my family. And do you notice what I didn't do there? I didn't say life insurance, which is a boring subject, but it's necessary. But at the same time, I want to dip into this in the future, maybe for education or to supplement my pension, because I didn't plan too carefully when I was 18 or 19. Or I might want to use it for estate planning or wealth preservation. I might want to help create charitable giving easily. And tax planning. I might want to create a key person protection to protect my business, as I've touched on. Okay, so how does it work? How does universal life operate? Well, it's very, very simple. And the first part is essentially down here, you've got your account value. That's your policy. We'll just call that the green bucket. And from this policy is the underlying cost of that insurance. And that's driven by a number of factors. It could be, well, it is someone's date of birth. Do they smoke? Where do they live? Are they male or female? Do they take any risks in life? Do they go base jumping from tall buildings? Or do they just lie on the beach at the weekend having a coffee with their friends? These are the aspects that together with Guy, we will put to the insurance company. And into this bucket, of course, comes the premium. Now, subliminally, we think of premium as cost, but it's not a cost because it's going out to work for you, as I'll show you now, because essentially part of that premium is buying the underlying cost of insurance, but the other part is growing, and it's growing in a way that is very, very clever. Ultimately, it's tracking an index such as the S&P 500. Now, I know the S&P 500 because it's all I talk about all day. It was founded in 1957. It's got a great track record. It's delivered around 9 or 10% a year, but it's had some pretty ropey years as well. But it's had some outstanding years as well. And here's the thing. Ultimately, what it's doing is capturing those years when it grows, and when it doesn't grow, it doesn't go down. And when it falls, when the S&P 500 falls, and it will, it doesn't go down with it, because it's tracking it. It's not investing into it. Instead, what tends to happen is that investment component sits with the insurance in their internal pot of money. And as such, it will be growing in things such as corporate bonds, treasury stock, debt, mortgages, predictable assets that create a smooth line going up. So S&P 500 launched in 1957. The downside is fully protected. You can take withdrawals from this in future years. And the upside is capped, meaning that if a market went up by, say, 15% in a year, you would get 10.25, for example, with one of the providers. And that doesn't mean they're skimming off the top. It's just that they've made allowances to get up to 10.25%. And even in those years that don't perform, you still get 2% each year. And we'll look at a case study in a second. So, for example, if the S&P goes up by 15%, policy would go up by 10.25%, and the investment component would do. And the policy illustrative rate is all driven by a very achievable growth rate, in this case of 6.39%. Everything is written into the framework of a trust. Why would I buy a trust? Because ultimately it allows the asset, the payout when someone passes away, to go to their beneficiaries. So for me, it's Claire, my wife, or Esme and Matt, my kids, smoothly and efficiently, so that one thing can happen: life can carry on. Let's look at 3 case studies. Now, instead of showing you 45 pages of quotes, I'm going to show you 1 page. So meet Pete. He's 55, makes great beer for a living, along with his 2 kids, Ollie and George, 35 and 25. So they have different priorities in life. First and foremost, they want to ensure that they can carry on with the business no matter what happens. It could be one of the sons that dies first, and it could be Pete. They want to ensure that their partners, their wives, are also going to be okay, and they have those financial choices to make, so that when one dies, there are options for the business, and it doesn't just fold up because Pete's died and so that his wife needs to be paid out. So they set up 3 policies, and I've abbreviated these very, very quickly, and I'll just go through the key points for you. As I said, this would normally be 45 pages of quotes. I always encourage, when people ask me for quotes, that they read the quotes themselves. This is really just a summary, but for the sake of today, I'm just showing you the summary. So Pete's 55, takes out a $4 million policy. In other words, in the event or when he passes away, $4 million is paid out to his beneficiaries. Now, that could be the business. It could be split between the boys, or maybe split 3 ways between the boys and his lovely wife. And he pays in $977,000. Great. So that's him done. No more money required. He's covered for $4 million the rest of his life. George, in the middle, at 35 years old, is doing a $2 million policy, and he can't afford to do a single premium, but he can afford to pay over 10 years. So he pays in $22,800 per annum for 10 years. Then he's done, and he's still covered. And Ollie, very similar story, pays over 5 years, and he pays in $80,000, and he's covered, and that's it. No more money to pay. But look at this yellow or gold area down there where my cursor is. Pete's 977 grand in 20 years, when statistically he'll still be alive, is now over $1.5 million. And it's a similar story for George. It's gone from $228,000 to $286,000. And for Ollie, he's also added 25% to his pot. And they're still covered, and they've got those financial choices in place. It's utterly brilliant. So to conclude on that point, the business is in safe hands, because that's why they did it. But also, statistically, Pete will die first. $4 million is paid out, which can pay off any outstanding premiums for the boys. And meanwhile, they're still both covered for $2 and $1 million, respectively. A capital outlay of $1.28 million is no mean amount. It's a very big amount. But in 20 years, we're now up to nearly $2 million in value. And there will be people out there, not necessarily only in this room, that say, well, I could get a term policy and I can buy cryptocurrency and unit trusts and shares. Fine, go ahead, do it. But your term policy will run out. And are you unnecessarily exposing risk, or too much risk, to a family to ensure that their future can be sustained? Whereas here, with the biggest and the best, you're not having to manage anything. You've got a whole of life solution, and you can carry on with doing what you do best, Pete, which is making great beer. And at the same time, in later years, you can take withdrawals. So it doesn't just have to sit there waiting for the Grim Reaper to arrive. You can take manual income each year, or you can create a loan facility to keep that life insurance there, but take a loan from the policy, maybe to pay for school fees, or to just pay for that holiday of a lifetime, or to supplement your income, or just cruise into the waves. It allows people the chance to breathe and grieve and just draw breath when something horrible happens. And I'm sure many of you have had situations where the stress levels go through the roof, intersquabbling happens between family members over money or the future, or what are we going to do, or who's going to live with who now that so and so is gone. And this is just creating that financial peace of mind to allow that not to happen. Now, if you like what you hear, then Guy is your advisor. I'm not your advisor. I'm a concept positioner. But what we do together is we look at illustrations based on your requirements, which are obviously your name, the level of cover you need. We're starting with $1 million minimum there of cover, and a date of birth, someone's gender, and the city and country where they reside. And importantly, do they have more than one passport? And if so, what are they? So we want to make sure we go to the right product provider, the right solution provider as such. And then I'm afraid if anyone's smoking, vaping, shishaing, patching, or gumming, cigaring, or piping, it all counts as smoking. So quotes are a bit more expensive. But that's not to say that in the future, if someone gives up smoking, their premiums can come down. And we've seen many, many examples of that with clients of mine all over the world. And then if anyone has any existing pre-medical conditions such as diabetes, or maybe they had a stent, or maybe they've had a heart attack in the future, they're the sorts of things we want to know now, so then we can present that and frame it accordingly with the provider in order to get the best deal. And then lastly, how is someone going to pay for it? Do you want to be like Pete and pay for it with a single premium? Or do you want to be like George and pay for it over 10 years? So it may be in tune with someone's retirement, or maybe they've had a nice big bonus and just want to get it out the way, like the first case study. And with the new business processes, we identify someone's health, their wealth, their lifestyle, and their professional journey. So health is easy, go for a medical, and we organize that and we pay for that as well. Wealth. Part of the process is for financial underwriting, where we assess someone's ongoing income and their assets so that we can highlight that they are appropriate for this type of protection. And their lifestyle, what do they do at the weekends? Do they lie on a beach? Do they have coffee with their friends? Or do something a bit more exciting? Maybe they go parachuting. They're the sorts of things. And professional journey. How did they become managing director of Microsoft or some big company? Just so we can gather that information and go to the insurance company and say, hey, this guy looks good. This lady looks good. We'd love to insure them for $5 million. And that, my friends, is universal life. I'll hand back to Guy now. I hope in the short space of time that we've had that you've managed to keep tuned in, and it will give you a bit of an idea of how it all works. I'm happy to answer any questions, and certainly for further inquiries, if you liaise directly with Guy, we're in touch most days, and we'll be very happy to help and support you. So I'll stop my share there, and back to you, Guy.
Thank you very much, Richard. Appreciate it. Hey, listen, since we have you here, would you just very quickly maybe sort of go over some of the cross-border advantages of universal life insurance, especially for people who may have assets in multiple jurisdictions?
Yeah, no, absolutely. Ultimately, this is the sort of insurance that we probably collectively, with all the providers we deal with, we have access to about 150 countries. So we've got insurance companies that will cover people in all those jurisdictions. So once we've ascertained where those people live, we can certainly look to organize a plan. So let me give you an example. Nigeria. A lot of companies won't even contemplate working with some countries in West Africa. I've been to Nigeria. I've made group presentations. We've had business from Nigeria. Zimbabwe is another one. A lot of people sort of write Zimbabwe off as a country that was, and it very much is. It's very, very vibrant. There are a lot of very high value people there. So someone in a country like that is undoubtedly going to have money in the country, but they may also have money outside of the country, and they may have assets outside of the country. So that comes under the wealth aspect of the underwriting, financial underwriting, and we will collate as much information from them as possible in order to then go to the insurance company. So we can pretty much cover, within reason, anyone, anywhere who falls into the category.
Thank you very much for that. I don't see any other questions right now. If anyone has any questions, feel free to drop, to drop us a message. If not, we'll let Richard go on his way, and we'll let everyone else kind of move on. Any questions from anyone? I know, and the reason why I asked about the cross-border situation is that I just know that a number of, obviously dealing with expatriates, and which is my primary focus, people do tend to accumulate assets over different jurisdictions. Not
Yeah.
to mention, things like forced airships back in their home country or the
Yeah, that's
country
a
that
very
they're
good
currently
point.
living in. That's maybe that's another area that you maybe could talk about, the forced airship, because I know that's an issue with some people, especially with significant assets.
No, you're absolutely right. I'm glad you've mentioned that, because the forced airship side can be effectively overridden based on writing a policy into trust, and we always write the policies into trust. So I'll give you an example. I won't go into too much detail, but it was
It can be a little bit sensitive, right? Yes.
it was a business partner of mine who sadly passed away, and he had two insurance policies with two very, very well-known providers. Now, one of those was in trust and one wasn't in trust. About a year and a half later, I went down to where he lived, and I had a meeting with his wife, who was part of the business as well. And the thing that struck me was this: thankfully, a very wealthy family. But I asked about the payment of the two policies, and she said the one that was in trust paid out within 14 days. And here's the worrying thing: the one that wasn't in trust hadn't yet paid out. Now, if you're on the receiving end of needing that money and you're resigned to the local courts or whatever rules there may be, then that's a problem. And if you only have one policy that wasn't in trust, it could be a problem. So what we want to do is create, and here's the thing, as much predictability in an unpredictable world as possible. Now, in her case, a very wealthy family, but nevertheless, that sort of cloud is always there. It has since paid out, but it took a while. So we want to make sure that we set it up efficiently with the best insurance providers on the planet in a way that will grow, that will be prevented from negative volatility, that will provide whole of life in terms of insurance, but also when the inevitable happens, it's a very easy process to have those you love paid out quickly so they can carry on with their lives.
And I think probably one of the biggest issues with the whole airship is especially people who have sort of blended families.
Yeah.
I think that's when it can really become a bit convoluted, especially when that person passes away.
Yeah, and we always hear of the reading of the will and people contesting wills, and we've seen many films where everyone sort of sits down. I mean, there's nothing worse than a family squabbling over money over someone that's just still warm, and sadly that happens. And the beauty of putting a policy into trust, or anything into trust, it avoids the necessity for probate formalities. In other words, the will can still be there, but the will does not apply to the payout here because that has already been done. Think of it as fund management or money management from the grave. Someone has made that decision already and it can't be contested. And that means, for me, when I die, I know who's going to get what. And so some long lost family members not going to try and throw a spanner in the works and slow the process down. It's very efficient.
And one last question, and I apologize for putting you on the spot like this, but one last question that I think that a lot of people could potentially benefit from are business owners, and how, people, because I know that so many people that I speak with, they're putting everything into their business. And, I think that the big concern with something like that is what happens to to the ones that you care about the most, should something happen to you. And could you just maybe touch on how universal life insurance could potentially help with the succession planning in terms of how the family members could still benefit from that business venture, even after the fact? Is that something you could touch on?
Definitely, yeah. And you're absolutely right. Businesses are great when everyone's health and it's coming in and profits are rolling in and clients are identifying with the key directors as the reason why they're there. So let's use an example. Let's say you've got a business selling fantastic jewelry, owned by three brothers, all of whom get on famously well, all of whom are married to, well, let's just say they're male for the time being and say they're all married to wives with children. But everyone gradually, as they get older, they have different aspects, different wants and wishes. And the trouble is with a business like that, if one of those directors passes away, then although the remaining two directors may say, that's this, we'll get by. If you haven't got everyone on the same page, you've got trouble. And so the first and foremost is the universal life slots in to create a plug really for the potential of that trouble not happening. So in other words, a payout would go to the chap who's passed away, to his wife and family, no matter what, and therefore mitigating the necessity for the business to have to fold. And it may also create a pot of money that could be used to go and woo the right new director, or to train the director that's in the wings learning how to do it. Maybe he's still in university or whatever. But it's allowing that to happen. It's allowing that inter-family potential squabble not to happen. And it does happen. And I've seen this happen. I've seen in parts of my own family, as soon as someone has died and the will didn't quite go their way, it gets very, very messy. And I'm sure many of you who are tuned in today have been in a similar situation. And that's sensible use of a universal life policy. It's often referred to as a key man or key person policy to make sure, as I said at the beginning, the show can carry on.
Thank you very much, everyone.